Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, the theory of asset allocation, part 3 in our series on basic education for financial literacy, sponsored by LifeSize Solutions and the Society for Financial Awareness. Well, welcome to our third segment, the theory of asset allocation. And did you hear the front end of my definition of our segment? It's a theory. It's not a science, it's just a good theory. It seems to be applicable for many investors, but it's still a theory and it's nothing to write home to mother about, and the G word, guarantee, is not associated with it. So here's some do's and don'ts when you're talking about stock market in decline, just in case you're going to prep yourself for this. These are some do's and don'ts. Don't evaluate specifically how each investment has performed as a result of the stock market decline. Compare performance of each security on its peers. So in its peer group, how's it doing? Then do selectively sell some of your losers along with some of your winners if you need to raise your cash assets in the near term. And by the way, especially if they're non-qualified and you want to do some tax harvesting by the end of the year, that's a great idea. Do continue to rebalance your portfolio if your asset allocation weightings have been altered significantly due to market volatility. Listen, assets change their weight and their ability and their beta. You need to kind of look at this. That's why I say it's always important to meet with your financial advisor every single year and see if your goals have changed, see if your risk tolerance has changed. It's great to keep this up. You should be meeting every single year on that basis alone. Then do continue to monitor economic news for any fundamental changes in the direction of the U.S. economy. You may want to re-asset allocate on that basis of those investments and see if there's a better way to accommodate the change in these fundamentals. These are just basic do's and don'ts. There's really nothing here but a basic idea just to give you a kind of place to understand. Don't panic. I know it's hard. Let me tell you, I am the worst to even bring this up. I don't want to panic. I'm trying to stay disciplined, but even I have wondered, should I have moved? Should I have sold off my position? If you're starting to lie awake, you might need to look at your risk tolerance test and take it over again. If you just can't find sleep and comfort and a little bit of solace, we need to figure out what we're doing here, because the stock market often has declines that are significant, but they have usually come back and upward in a historical sense. But it depends upon your psychological view. If you just can't handle it, maybe you shouldn't be in it, even though you have long years before you take constructive receipt in a retirement scenario. Don't sell all your investments at one time when the market declines. This only ensures that you'll probably realize a loss immediately. I can't tell you, in 1987, we all, including myself, knee-jerk reacted against this and sold off every position across the board. It was a big mistake. Too bad we didn't jump in for months on end. We kept thinking it's going to get worse, and it didn't. So it recovered quite fast. Don't jump into the stock market with all your available cash, hoping the market has hit its bottom. You may choose the wrong time to enter, and you have to keep money on the side. That's why I like dollar cost averaging. You commit to something, it's a discipline, it becomes a habit, it's a good lifestyle. Every month you're saving money at the same regular rate. I don't want to start going all in. I'm not in Vegas, I'm in your retirement planning. And last, don't listen to Wall Street pundits about the short-term direction of the market. It'll only make you feel like you're losing the high end of this issue and you're not profiting. It's better to take the disciplined approach, and remember, if you're reading some of these financial magazines, some people call them financial pornography. They have not been right many times. So the steady pace, the steady amount that I'm putting in every month, that's probably the way I should go. Okay, now I want to talk about common investment mistakes as we're on this theme. Remember, selling after the market has dropped is significantly a problem, and waiting to buy until after the market has already made a major jump or whatever upheaval, this is a problem. So I want to be able to come in and stop chasing last year's hot investments. Generally speaking, and this is not always true, but generally speaking, what was hot in a previous year may not be hot in the next year. Water cooler tips from other people are probably not the way to go. You want to deal with investment advisors, especially in securities, when you're dealing with stocks, bonds, mutual funds, and ETFs. Talk to people that are licensed to do this, that are completely insured with errors and omissions, people that have really looked at this and understand it. So it's really critical. Here's a graph. Example of market fluctuation. If you look at this, an example of selling low, which is near A, and buying high, which is near B. Now, again, we're not going to be able to, we don't know how it's going to go down, so I can't time it there. I just got to get somewhere in this vicinity when I buy. Don't try to time the market. It's really difficult to do. Most people do not succeed. They fail. This looks like my chemistry chart in high school, I have to say. This is the Callan Periodic Table of Investments Returns. Annual returns for key indices ranked in order of performance. And it gives every year from 96 all the way out there to 2015. It'll show you, did the S&P win that time? What was happening with the Russell 2000, the MSCI? You know, you want to look at every single option out here and see that nobody ever wins all the way across the board. But you do see some ideas here. Interesting that some of the things that were doing quite well, some of the emerging markets, but they're not doing so well now. So you want to really look at how these things play out and look at a map and see that this is a proof text to why you can't depend on one indice or anything else in the market to always be winning all the time. Changes in the market leadership are unpredictable, as I've just shown you. There's no investment category that performs well all the time. Oh, I want to do aggressive growth. Oh, I want to do balanced income funds. No, we don't know which one's going to win. There's no kind of regular predictability on who's going to win, even in asset classes, which we're going to get in the next segment. Different categories frequently move in different directions. The market is highly correlated, so you have to figure out how you're going to play in a highly correlated market. And on top of that, we're highly correlated in a global market. So things that happen in the world affect our market. And then the leader in 1 year is often an underperforming in the next year or 2 years later. It's really important to understand that because you can't keep depending on having mutual fund companies PR, their PR is their own self-promotion. You have to make sure that you're looking at the math and science and you're talking with your financial advisor who's licensed to discuss these things with you. A strategy for creating a personalized portfolio by combining stocks, bonds, and cash equivalents in various proportions. The second, the selection of the style and class of investments as well as the percentage of weighting within each investment. Classification and the weighting. Again, your advisor can walk you through the mechanics and the definitions. And the science or engineering behind the design of a portfolio. Some people are Monte Carlo theory. They like that, the asset allocation theory that they present to their clients as a way to invest in the long haul. History of Asset Allocation, Dr. Harry Markowitz, Portfolio Selection article published in the Journal of Finance in 1952. That is so long ago, it's almost the time I was born. Think about it, it helped develop the concept of efficient portfolios. Now we're trying to go to another step, which is I not only want efficient portfolios, I want efficient expenses for those portfolios. And then why is asset allocation so important? Proper asset allocation can lower the overall investment risk of a portfolio. It can also have the specific investment mix you choose may directly affect the potential return. So again, an advisor can help you walk through that. Individual asset classes may respond differently to the same market conditions, and we're going to talk about that in the second segment. These are just basic concepts so that you can become somewhat financially literal, have some financial literacy, and we'll be able to talk about that in the next few segments. Don't forget to watch our next segment on Understanding Asset Classes, Part 4 in our series on Basic Education for Financial Literacy. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.